Michael Vogelzang into this conversation. He's President and Chief Investment Officer of Boston Advisors. He oversees $1.8 billion in assets. Michael, great to have you back here. Safe to say you're pretty disgusted by what we've seen in Washington over the last month or so.
Yeah, tell you what, Carol, I didn't lift my skirt up, but if I did, I'll tell you, everybody would be disgusted. I love the image. You know, the fact of the matter is, this is what it takes for our current political representatives, I use the term loosely, to actually get something done. And it wasn't even that much. I mean, it's a relatively modest compromise. It's clearly kicking the can further down the street. But, you know, they had to basically put guns to each other's heads in order to get any kind of a decision made. And this is the embarrassment, right? Teddy's point was exactly right. It's the process. There was some minor progress made. It does take off some specter of larger deficits. It certainly changed public perception of what it means to have debt and deficits.
Right.
But oh my goodness, at what cost was it? Quite a heavy one.
Yeah, absolutely. Hey, we're going to get back to the conversation in just a moment, but I want to bring into the mix everybody some earnings. We are getting numbers from CBS. Suzanne, what does it look like here?
They look pretty good, Carol. CBS actually came out with profits of 58 cents. That's ahead of 46 cents, what Wall Street was expecting. Revenue at 3.59, right in line. The stock is modestly higher in after hours. CBS, a very interesting story because this stock is the best performing media name this year. It's gained about 38%. There's been a lot of bearish activity in the options market ahead of this report. A lot of traders were betting that CBS would not meet its numbers. Now, we just got the numbers. We're continuing to go through the release, but it looks like a solid quarter. We don't have the forecast just yet, Carol. I'm looking into that, but it appears again that traders had it wrong, and a lot of folks, including the team at Deutsche Bank, said CBS, people don't understand what a great growth story this is. They turned bullish on the stock a couple of weeks ago. So CBS climbing in after hours, finally a piece of good news. And these media companies, as we know, in particular with CBS, is heavily exposed to the economy via ad spending. So whatever they say on the conference call today will be closely linked, especially since we're talking about potentially a double dip in the economy.
And
Carol?
let's not forget, you take a look at this stock price. It's up about 37% this year. So despite the concerns, investors like it a lot. Hey, Michael, when we talk, you know, we've spent so much time talking about what's going on in D.C. right now, understandably so. But let's step back. Here we've got earnings from CBS. Investors like what they heard. Investors in general liked a lot of what they heard from companies. What was your take on earnings this season? And Ken, you know, what are you going to expect that we're going to get from these companies over the next 6 months here?
Well, I think we're going to continue to see decent results from corporate America. You know, corporate America is doing an unbelievable job with efficiency and productivity. So, you know, fewer people, fewer amounts of stuff to make what it is they're making or provide services they're providing. So, you know, we've actually seen terrific results, particularly those companies that have exposure overseas. I think you were talking about Herbalife earlier in the segment, right? They had great numbers overseas, particularly from emerging markets. That's really been a powerful driver for corporate earnings. So the consumer's flat on its back with these twin towers of housing and unemployment. That's what's really vexing the politicians, because these guys without term limits know they're not going to get elected if they can't fix that problem. The only bright spot is corporate America, and frankly, given the strong earnings we have and given the reasonable valuations, we think there is a floor under this market. We don't think this is a doomsday scenario. We don't think we're going to drop off the face of the earth. We think actually that we're getting kind of interested in this market the more it gets down here. So we are looking to increase our allocations. We're not quite there yet, but we think that given the good valuations and the good performance from corporate America, things are actually okay there.
Hey, Michael, it's Julie here. I'm glad you brought up the international aspect of earnings, because that's a trend I've been watching with so many companies getting a lot of their earnings from overseas. And those are the companies that seem to be doing the best here. The question is, if the U.S. is indeed slowing down once again economically, do you have the decoupling where the emerging markets hold up, or do you have them slowing as well and then coming back to bite these companies that have been relying on that international growth?
So who's the engine that could? You know, that's the question, and I think it'll be interesting to see. Clearly, the emerging economies would welcome a little bit of respite from you know, some softer growth elsewhere, because they're clearly trying to dampen down growth by higher interest rates and slowing down their monetary growth. They're worried about inflation. I think a little pause in growth around the developed world would actually provide them a little bit of boost. I think they'd welcome that, although they probably wouldn't publicly say it. I think the U.S. is clearly getting pulled along by some of the emerging markets and some of the more aggressively growing developed markets, and you know, we'll see what happens. I think all of corporate America, of course, is tied to what U.S. does. Most of corporate America. I don't think we're going to see a double dip, but right now consensus is falling quickly. sentiment is pretty darn negative. So it could be a self-fulfilling prophecy.
You know, you talk about a potential for a double dip. Michael, we actually caught up with Harvard economist Martin Feldstein. He says it's up to a coin toss whether or not we have another recession. Listen up, everyone.
There's been no increase in consumer spending for 4 months in real terms. So this economy is really balanced on the edge. I think there's now a 50% chance that we could slide into a new recession.
Michael, how worried are you about the economy at this point? I mean, if you were a betting man, do you agree it's maybe a 50% chance that we could see another recession here?
Well, we bet every day, right? I mean, I think it's probably not quite that high, although I understand why he says that. I mean, the real question becomes, again, how does corporate America do? The real wild card in all of this, and we've said this many times in this program, is if things get bad enough, we're going to see another round of stimulus from the Federal Reserve. And if that's the case, you're going to see a pop in gold prices, you'll see a pop in stock values. So, you know, the feedback loop is very important here. And trust me, the Federal Reserve is watching today's market action very closely. And at some point, you know, if we fall enough, we're going to get the Bernanke put into play, and we'll see some more stimulus. And that, of course, will help the economy out.
Hey, Michael, that being said, what's on your shopping list? What are you buying on a day like this?
Not much. You know, we're selectively nibbling. We're adding exposure to, not surprisingly, some of the more stable areas of the economy, consumer staples. We're a little worried about healthcare because of the reduction in federal dollars going into the healthcare sector. So normally we'd be buyers there, but we've been a little hesitant there. We're basically taking some of the aggressive cyclical exposure off the table that we've had on for quite a while. So they've treated us very, very well. There's a reason consumer discretionary and industrials are down the most today. So, you know, we've been buying in places where some of that weakness is less pronounced and actually getting a little bit of benefit.
Michael, Julie again here. You mentioned that one of the things that could get a pop if you have the Fed come in again is gold. Gold has certainly already gotten a pop. Its rise continues to rise here in trading. Almost to 1662 is the high that it reached today. It's trading right now around 1659. Are you buying at these levels, or are you just holding fast with your gold position and betting that it's going to continue to go up?
Well, gold, I mean, we're adding marginally, but gold is the insurance policy here for further debasement of the currency. So around the globe, and so particularly developed countries. You know, interestingly today, you didn't see a huge spike in the dollar. You saw a big swing a big rally in the Swiss franc, which seems to be, you know, remarkably becoming the world's reserve currency, at least a place to hide when things get tough. So it's interesting to see what's happening, but clearly people are worried about the Federal Reserve and flooding the system with more money, debasing the currency further, and people are buying gold for that very reason. And it's an insurance policy against the Bernanke put, and I think it's well founded, frankly.
Also hard to bet against the long-term track record when it comes to gold as well. Hey, Michael, we got to run. Thank you as always.
Thanks a lot.
Michael Vogelzang over at Boston Advisors.